2022 is said by many people to have been the hardest year ever for investing. So a lot of people called it the death of the 60-40 portfolio, meaning the 60% that's stocks, 40% bond portfolio that historically for most retirees has worked and given you proper asset allocation and diversification. So what made 2022 so difficult for investors? Well, first and foremost, this is one of only 3 years ever in the stock market that both stocks and bonds were down in the same year. Bonds were down about 13% this year, and large cap stocks were down about 18 to 19% in 2022. So what was causing most of the drawdowns in both stocks and bonds? Well, they both moved in similar fashion, and it was because of the historic inflation rate that we saw, the highest it's been in 40 years, and also rising interest rates. So rising interest rates plus inflation were very bad for bond prices and drove a lot of bond prices down. What that also led to is the tightening of the money supply, causes companies to panic. Some of the high-flying tech names took some of their biggest hits as well in 2022. So for many people that may be looking at their statement in January, seeing what happened to their portfolio in 2022, really the only two asset classes that were up on the year, that were positive for the year. One was commodities, which typically refers to things like corn, wheat, and mainly oil. So that was led mainly by oil and gas. A lot of the oil companies were up on the year. There were some healthcare companies that were up on the year as well. And then the other positive asset class for the year was cash. So cash was up about 1.5%. There was some silver lining with a lot of banks, mainly online banks, offering high yield savings. So a couple high yield savings rates are in the 3, maybe even as high as 3.5% range for just having your money in cash. So really the only safe place in 2022 was to be invested in cash, or like we said, to look at some energy and oil companies. So for those of you that may have be looking at your statement in January, or looking at some of your account balances for 2022, just know that if you were in a diversified portfolio, there really was no safe haven for your money and for your assets during that year. So where does that lead us now? One of the things to look at with how much stocks have dropped, there is a lot of room for recovery. So far this year in 2023, we have seen the stocks that have performed best were the stocks that got hit the hardest in 2022, with the NASDAQ being up over 11.5% this year. The S&P and the Dow are also up on the year. So it seems like we have been rebounding, at least so far in January and February of this year. Couple of things to be aware of and look at. So the Federal Reserve did come out and say that they believe that inflation is starting to decrease. So looking at where inflation was last year at an all-time high, pretty easy to see that hopefully that does start to come down, and we have seen that so far this year. And a couple of the comments that Fed Chairman Jerome Powell has been announcing and talking about was some of that disinflation, so market prices coming down. However, we do think that'll be a little bit of a seesaw with some issues in supply chain and also inventory levels being high in most warehouses. So that'll be an ongoing factor. This is shooting this on Monday. Tuesday, the 14th, is when we should see a consumer price index report come out to really give us another gauge on what inflation might be telling us. If you were to look at housing, so housing so far this year, mortgage rates across the country are starting to decline. They're starting to drop back down somewhere in some areas around that 5% range for a 30-year mortgage, which got as high as 7% towards the end of last year. So housing is an important area to look at. And then also with the potential for inflation going down, and like I said, a lot of room to recover in these high technology names. These have started to rebound relatively quickly. So something to keep an eye on so far this year, making sure that you're maintaining a diversified portfolio, because as we start to see interest rates start to decline, and also inflation starting to decrease, this would be a good time to get into those stocks that had mainly been hit pretty hard last year and hopefully recover some of those losses that we saw in 2022. So making sure that you don't panic now, making sure that you stay disciplined with your investment approach. Think for the long term. So think about the money that was hit hardest and that having the quickest recovery, because typically when it does happen, when we do see recovery, you don't want to miss those days in the market. You don't want to miss those 5 to 10 best days for the year for your portfolio in the stock market. It's very important to have a customized investment plan in place during these times. So looking at when you will be spending down your assets, what money you'll start to pull from first, and bucket out what's my 12-month money, what's my 24-month money, and having that money safe, maybe in some laddered CDs, laddered treasury bills, to make sure that that money is, one, outpacing inflation or at least getting something close to it, and you're getting a little bit of return on your money for that. But more importantly, that money is safe, and it's safe, it's stable, and it's there when you need it. Then for some of your longer term buckets of money, look at high dividend paying stocks, look at companies that have strong cash flow and strong profits and a history of growing their dividends and growing their earnings as well and growing their profits. So Warren Buffett typically said he wants to see 10 years of profit growth within most of these companies. Look for some of those names within your portfolio. Companies like ExxonMobil, companies like Expedia that have high profits, Clorox as well has done well and shown some strength. So those are just a couple of names of stocks that over the long term have been able to grow and maintain healthy profit margins. And in the case of ExxonMobil and companies like Procter & Gamble still paid a healthy dividend as well. So even if your account is dropping or if those stocks are maybe decreasing, you are getting that dividend payment. If you're reinvesting those dividends, you're buying your stocks in at a lower price. So you're accumulating more shares, which can lead to better returns for you as that money starts to recover. So most important thing, now that we're through 2022, which was historically one of the worst years for the stock market on record, make sure that you don't panic, have a disciplined investment approach in place, and continue to maintain some exposure to stocks so that you don't miss those quick recoveries that we oftentimes see within the stock market.